So imagine you're standing right on the floor of the New York Stock Exchange. The bell rings, and a company announces they just pulled off one of the greatest quarters in recent corporate history.
Right, just absolute blockbuster numbers across the board.
Exactly. I mean, revenue is up a staggering 33%. Net profit didn't just grow, it completely skyrocketed by 61%.
Which is practically unheard of for a company at that scale.
It really is. By every traditional metric they teach you in business school, it's an absolute triumph. You'd expect champagne corks popping everywhere.
Yeah, but instead the stock just instantly craters.
Drops roughly 10% in after-hours trading. Just wipes out billions in market value in a matter of minutes.
It is the kind of massive disconnect that really forces you to question everything you think you know about how the market values technology.
We are, of course, talking about Meta and their first quarter earnings for 2026.
I mean, you have a company essentially printing money, and Wall Street's immediate reflex is just to hit the panic button.
And today, we are taking a massive stack of sources for this deep dive. We've got the actual Q1 earnings call transcript. We've got detailed analyst notes from Morningstar, plus deep dive reports from eMarketer, Benzinga, MXC, and Me3.
It is a lot of dense material, but we are going to figure out exactly what spooked the market so badly.
Because whether you are an investor, managing a portfolio, or a digital marketer trying to sell products online, or just someone who is insanely curious about big tech, you really need to understand the $100 billion plus problem hiding in these numbers.
Yeah, it affects the entire digital ecosystem.
Okay, let's unpack this. How does a company report a 61% jump in profit and still trigger a massive sell-off?
Well, you have to look past the headline numbers. You have to dig straight into the ledger, because that massive profit jump was, honestly, largely a mirage.
A mirage, but I mean, the numbers were real, right?
They were real on paper, but when institutional investors read an earnings report, they don't just look at the final dollar amount. They look at the quality of those dollars.
Right, like where that revenue is actually coming from.
Exactly. And on paper, Meta's earnings per share, which is the profit divided by outstanding shares, hit an incredible $10.44.
Which sounds like an absolute gold mine. If you just read the notification on your phone, you'd assume the core business just became hyper-profitable overnight.
Right. But the reality check is sitting quietly on the tax line.
The tax line.
Yeah. Out of that $10.44, a huge chunk was driven by an $8 billion income tax benefit.
Wait, $8 billion just from a tax adjustment?
Yep.
How does a company that size even get an $8 million break in a single quarter?
Well, it wasn't a reflection of new business at all. It was actually a retroactive accounting maneuver.
Okay, how so?
So the U.S. government recently updated some Treasury rules, specifically U.S. Treasury Notice 2026-7.
Oh, okay.
It's regarding the corporate alternative minimum tax and how past research and development costs are treated.
So they basically just found a loophole.
Pretty much. Meta realized they can claim a massive one-time credit for money they had already spent in previous years. To put it in perspective, because of this one maneuver, Meta's effective tax rate for the entire quarter was actually a negative 23%.
Negative 23. So the government was essentially paying them.
Exactly.
Okay, I see why Wall Street ignored that. So Wall Street saw right through the mirage. It's like bragging to your friends about a massive bonus at work, but it turns out it was just a giant one-time tax refund from the IRS.
That is the perfect way to put it. I mean, it looks great in your checking account today, but it tells you absolutely nothing about your actual earning power tomorrow.
And investors strip out those one-time benefits immediately.
They do. And when you remove that tax trick, Meta's actual earnings per share dropped down to about $7.31.
Which is still a solid quarter, but definitely no longer a miracle.
Right. But, the tax illusion isn't what actually caused the 10% crash.
It wasn't.
No. When analysts stripped away the noise and looked at the core structural metrics, they found something else. Another red flag for investors regarding the actual humans using the platform.
Are we talking about the daily active users? Because I thought I read they hit 3.5 billion people.
They did.
That's almost half the planet.
It is. Meta tracks a metric called daily active people, or DAP, across their entire family of apps. So that's Facebook, Instagram, WhatsApp, and Messenger.
Right, the whole ecosystem.
Yeah. And they hit 3.5 billion, which technically is up year over year. But investors don't just look at year over year, they look at sequential growth.
Meaning from the previous quarter.
Exactly. From the end of 2025 to the beginning of 2026, that 3.5 billion figure actually represents a slight sequential decline. They lost momentum.
Meaning fewer people were logging in daily in March than they were in December. Why? Is it just platform fatigue? Like, are people finally getting bored of scrolling?
Well, according to Meta's management, it's mostly geopolitical.
Geopolitical.
Yeah, they explicitly pointed to widespread internet disruptions in Iran and blocks on WhatsApp access in Russia.
Oh, wow.
So it's not necessarily that the product is failing, it's that entire countries are being disconnected from their servers.
Right. But even with the geopolitical excuse, tech stocks are priced for absolute perfection. They are valued on the assumption of perpetual, unbroken growth.
Exactly. So any sequential drop, no matter the reason, is going to make investors sweat.
But still, I mean, a minor user drop in a sanctioned country and a one-time tax trick doesn't erase 10% of a multi-trillion-dollar company's value in a matter of hours. There has to be a bigger catalyst for the panic sell-off.
There is. And it has nothing to do with what Meta earned this quarter. It has everything to do with what they're about to spend.
Ah, the expenses.
Yes. The real bombshell of the earnings call was buried in their guidance for capital expenditures, or capex.
CapEx being the physical stuff, the buildings, the servers, the actual hardware required to run the internet.
Right. Meta raised their 2026 capex guidance to an astronomical range of $125 billion to $145 billion.
Wow.
And if that isn't staggering enough, their Q1 multi-year infrastructure commitments, meaning the contracts they are locking themselves into for the future, rose by $107 billion.
Wait a second. $145 billion in 1 year, plus locking in another $100 billion for the future.
Yes, in a single quarter.
That is a mind-bending amount of cash. What exactly are they buying?
Artificial intelligence. Meta is going all in on building out their Meta superintelligence labs.
Right, we've seen Mark Zuckerberg talking a lot about this lately.
Yeah, they're training massive new frontier AI models, specifically the upcoming Muse Spark and Llama 4.
But why does that cost hundreds of billions?
Because you can't just code those into existence on a laptop. You need physical data centers the size of small cities, packed with specialized microchips.
Okay, that makes sense.
And during the call, their CFO pointed out that they are facing significantly higher component pricing, particularly for high bandwidth memory, which is essential for AI processing.
So the hardware itself is getting way more expensive.
Right. Plus, there are reports from Morningstar analysts that Meta might invest up to $10 billion into a single AI startup called Scale AI.
$10 billion into a startup just for what?
Just to secure the human labor needed to label the data that trains these models.
Wait a second, I have to actively push back on this entire strategy here.
Oh,
Because when a public cloud provider like Amazon or Microsoft announces they're spending $80 billion on AI servers, the market applauds. But that makes economic sense.
because they rent it out.
Exactly. AWS and Azure are cloud providers. They buy the computing tower, and then they rent it out to thousands of other businesses like a utility company. Meta is not a cloud provider.
No, they are not.
They don't rent out server space. Why on earth are they burning through hundreds of billions of dollars building generative AI chatbots from scratch when they could just license the technology from OpenAI or Anthropic for a fraction of the cost?
This raises an important question, and it is the exact question that has Wall Street terrified. You hit the nail on the head.
I mean, it just doesn't seem to add up for a social media company.
Morningstar's analysts expressed deep skepticism in their notes for this exact reason. As of right now, Meta has absolutely no clear, proven monetization strategy for a consumer-facing chatbot.
So they're building the most expensive infrastructure in human history to power an AI assistant that they're going to give away to Instagram users for free.
That is the current plan. The hope is that a hyper-intelligent AI assistant keeps you engaged on the app longer.
But from an investor's perspective, that is an incredibly speculative gamble.
Highly speculative, especially when you consider Meta's recent track record with other speculative projects. Don't forget about Reality Labs.
Oh, right, the augmented and virtual reality division building the metaverse.
Yeah. That division alone continues to hemorrhage cash. They posted a $4 billion operating loss this quarter alone.
$4 billion in 90 days, despite slight improvements, right?
Yes, management notes it's a slight improvement from past quarters, but it's still a massive financial black hole. So look at the board from the market's perspective.
Yeah.
You have a company pouring billions into VR headsets that the mainstream public still hasn't adopted. And now they are committing over $100 billion to AI infrastructure with no direct subscription or rental revenue model.
Wall Street is terrified. Meta is throwing money into a bottomless pit.
Exactly.
When you lay it out like that, it sounds catastrophic. Billions burned on the metaverse, hundreds of billions committed to chatbots we aren't paying for, user growth stalling out, and the profit margin propped up by an IRS loophole.
It paints a bleak picture.
If we stop the deep dive right here, it sounds like the stock should have crashed 50%, not 10. But I know there's another side to this coin.
There's a very important other side.
Because some of the analyst notes we reviewed are actually incredibly bullish on the stock's future. So why? What is everyone missing?
They are missing the hidden AI engine. Everyone is distracted by the flashy chatbot announcements and the VR headsets. But if you look strictly at the core business, the advertising metrics, you realize that Meta is actually pulling off a quiet masterstroke.
Okay, we found a stunning projection from eMarketer in the source material that really highlights this historic milestone.
Yes, the 2026 forecast.
Exactly. eMarketer is forecasting that in 2026, Meta is going to surpass Google in digital ad revenues for the first time ever.
That is a seismic shift in the architecture of the internet. Google has been the undisputed king of digital real estate for 2 decades.
And the numbers are huge. Meta is projected to reach $243.46 billion in net worldwide ad revenues this year.
Compared to Google's $239.4 billion.
That means Meta is capturing roughly 26.8% of all global digital ad spend. Here's where it gets really interesting. How are they doing that? If user growth is basically flat, how are they suddenly overtaking Google?
Because that massive AI investment, the capex that Wall Street is panicking over, is already working brilliantly in the background.
Oh, so it's not just for chatbots?
No. Yes,
Oh.
the consumer-facing chatbot doesn't make money yet. But behind the scenes, Meta has integrated new AI architectures into their core ad ranking systems as an ad optimization machine.
What kind of architectures?
They are using models called Lattice and GM, and they are functioning as the ultimate optimization engines.
Okay, let's break down the mechanics of that, because AI optimization gets thrown around a lot as just a buzzword. How is a model like Lattice actually different from the algorithm Facebook was using 3 years ago?
Think of older algorithms as setting up a few basic rules. If a user likes a page about marathon running, show them an ad for running shoes. It's very linear.
Right, basic targeting.
But Lattice and GM act more like a digital nervous system. They don't just look at what you clicked. They analyze thousands of microsignals simultaneously.
Like what?
How fast you scroll past a certain color, how long you linger on a specific video format, the exact time of day you tend to actually make purchases.
Wow, so it's hyper-personalized.
Exactly. They process all of those fragmented behaviors in real time and predict your specific willingness to pull out your credit card at that very moment.
And the data proves it's working. The earnings call noted that enhancements in the Lattice and GEM architectures drove a more than 6% conversion rate gain for something called landing page view ads.
Right, and we should explain why that matters. A landing page view is when someone clicks an ad on Instagram and is taken to the advertiser's website.
Right, they leave the app.
And historically, tracking what a user does after they leave Instagram is really messy, especially with new privacy rules on phones. But Meta's AI is bridging that gap.
Meaning, if I am a business owner and I pay Meta to show my ad, the people clicking it are demonstrably more likely to actually buy my product.
Exactly. And it's not just targeting, it's the creation of the ads themselves. Meta now has over 8 million advertisers already using Gen AI creative tools.
So the AI isn't just deciding who sees the ad, it's physically generating the images or text.
Yes, advertisers can give the AI a basic product photo, and the AI will generate multiple background variations, optimize the text for different demographics, and test them all simultaneously.
That's incredible.
And because the AI is serving up hyper-relevant content on the user side, engagement is skyrocketing. The call mentioned engagement is at a 4-year high for video watch time.
Because the AI recommendation engine knows exactly which reel will keep you from closing the app. It's a closed-loop system.
Precisely. They use AI to keep your eyes on the screen longer, and then they use AI to ensure the ads you see while you are scrolling are mathematically optimized to make you buy.
Which brings us to the marketer's dilemma. Because the ad engine is firing on all cylinders. But who is footing the bill for this newfound AI efficiency.
Well, that's the catch.
If you are a business owner or a marketer listening to this, buying ads on Facebook or Instagram, you might logically think better AI means cheaper ads.
That would make sense, right?
Right. But the data shows the exact opposite.
We have to look at the Q1 ad metrics to understand the squeeze. Ad impressions. The sheer number of times an ad was shown to a user rose by 19%.
That makes sense. People are watching more video.
But the average price per ad also rose by 12%.
So Meta's growth is no longer coming from explosive user expansion. It's coming from deeper AI-driven monetization of existing users.
If we connect this to the bigger picture, it represents a massive power shift. Meta is squeezing more value out of the same attention.
And keeping the profits.
Exactly. The efficiency gains generated by AI are being captured by Meta, not passed on to the advertisers.
It's like a casino figuring out how to make the slot machine spin 20% faster while simultaneously charging you more per pull and calling it an efficiency upgrade.
That is a great analogy. The machine is technically more efficient, but the casino is keeping all the extra profit.
The gambler isn't winning more money.
Right. Marketers are paying more because the AI is technically delivering better returns on those landing pages, but it means they are completely dependent on Meta's walled garden.
Is there any looming cloud that can derail this train? Because if competitors can't build a better AI, what stops Meta from just raising prices another 12% next year?
The only real threat to this massive cash cow is active regulatory headwinds.
The government.
Yeah, there is youth protection scrutiny, but the existential threat lies in the ongoing U.S. and EU monopoly trials.
Could those actually threaten this highly profitable walled garden?
Absolutely. Regulators don't necessarily need to break up the company to cripple the ad engine. The European Union is looking very closely at how Meta pools consumer data across its apps.
If they build walls between WhatsApp and Instagram, the AI loses its fuel.
Yes, the algorithm is only as accurate as the cross-platform data it consumes. Cut that off, and those price hikes become impossible to justify.
So what does this all mean? We started with a 10% stock crash. But the takeaway here is that the crash isn't a sign of a failing business.
Not at all.
It's Wall Street struggling to stomach the massive, expensive pivot required to build Meta's AI infrastructure.
Investors hate deferred gratification. But the analysts who look past the immediate sticker shock remain bullish. In fact, Morningstar still views the stock as undervalued.
Right. They set a fair value estimate of $850 compared to the $668 close.
They believe there is massive upside once this new AI infrastructure fully matures.
It's a masterful transition. But we have to leave you with one final, incredibly provocative thought to mull over. Because Mark Zuckerberg's ultimate goal goes far beyond just optimizing ads.
Yes, he explicitly wants to build a personal superintelligence for billions of people.
An AI assistant that manages our daily lives. If Meta controls that assistant, will the advertisers of tomorrow even bother targeting us?
Or will brands be forced to bid against each other just to influence our AI assistants?
Exactly. It completely rewrites the economy. Thank you for joining us on this deep dive. Keep questioning the headlines, look for the mechanics beneath the numbers, and we'll see you next time.